Hi guys, welcome back. So today we're going to be discussing the entire footwear space. So I will just summarize the whole footwear space with what is happening in individual companies, and we can go forward with it because nothing major changes you can see in footwear space compared to last quarter or at least over the last 3 quarters. So it doesn't make sense to talk about it every company individually and waste time. So first thing is I'll just give you the order from the best to least of all the companies, from the best company that is out there in this space to the least favorable company. If you look in terms of everything, you'll see that Red Tape has been the fastest growing company in this space, followed by Metro Brands Limited. Then I would put Campus and Relaxo on the same range, and then you have the likes of Khadims and Liberty. Right now, if you look at all of these companies, one thing is common, is that at least those who are selling a bit of a premium shoe or in that semi premium shoe, they are surviving really well in spite of a very muted consumer demand that we've had. And those companies that are selling still in the economy range, because in the rural place we are still having inflation, still people are not readily willing to spend. We haven't seen the rural economy recover. Even this part, the other three, that is whether it is in terms of Relaxo or Khadims and Liberty, they are still finding it very hard to recover in terms of volumes. And even if they have volumes, what is happening, this volume growth is coming at a cost of value degrowth, right? So this is the common narrative you will see. And this time you will also see that in spite of having a very strong festive season, right, in Q3 that we've had, you will see every company is talking about how the consumer demand was muted. And it is not just related to footwear space. If you look at a lot of B2C brands, you will see that consumer demand has been, that is a very common narrative you will see. Okay, so now first let us start on an individual basis. Let us start with Red Tape. If you look at Red Tape has done exceptionally well compared to the rest of the players. You will see that the Red Tape has grown by 30% on a year-on-year basis, but उनका PAT didn't grow at a faster rate compared to sales, right? You will see the company lacked operating leverage. Now this could also be because Red Tape is in an expansion mode since it demerged from their parent company, from their entity Mirza International. And they could be expanding some stores. They could be adding new stores, new inventories or whatsoever. So because of that, you will see probably that operating leverage has not come into play. Now I do not know why the operating leverage has not come into play, because you see, right, I only depend on con calls and whatever the management has told to convey the message to you, right? That's how I always do my work. But here, Red Tape doesn't do any con call, and whatever the latest information in terms of document wise you have is from annual report, and that is like a 9-month old data, and we are like 9 months after that annual report. So it doesn't really make sense to go there and quote those data that is there. So the only problem with Red Tape is I would say, although it is the best player in the space, the only thing is you do not know what the management is up to, what has been the same store sales growth, what has been the addition of stores. None of this data that we have right now, other than the fact that if you look at your income statement, it shows that the company is at least doing really well, like we hope for. Next we have is Metro Brands, which is apparently the second in this space. You'll see, of course, Metro Brands problems still persist. You're seeing every quarter that you're seeing that the sales growth are falling. So you will see that the pace of growth has fallen, right? Every time you're seeing 40% jota, 35%, 25, 18, abhi 15 last quarter, and this quarter it is 6, in spite of again very strong festive season. I think a lot of them expected it to do at least better than last quarter, but having said that, it hasn't been, right? So if you look Q2 on a year-on-year basis also, it grew at a faster rate compared to Q3 year-on-year basis. Now see, earlier at least it was okay if Metro was growing at a faster rate. Let's say if it had 30% ka and 25%, at least if it was growing at that point, or at least even 20%, then it would have been, it was a great, it is still a great company. The management is good, it is a very strong B2C brand also. But the fact is, now first, without operating leverage, having sales growth at least is fine, because I understand they're in the expansion mode and they're doing acquisition and all. But right now, the combination of both lack of operating leverage as well as the pace of growth falling down, and at this valuation that it exists, right now I think Metro is at 70p, and the market cap is also so huge. It just doesn't make sense right now, to be paying such a premium for a 7% ka growth engine, 6.8% ka growth engine ke liye aap 70p ka valuation pay kar rahe ho, 70 times more earnings that you pay. So that is the only problem. The earnings and the valuations that it it doesn't match anymore. Okay, but other than that, if you look at it, like if I have to delve deeper into the business, you will see that, other than the sales growth that is there and lack of operating, the company is still doing well. Whatever the store expansion that they had, like during the IPO time, they told, right, they want to open like 900 stores or something. So they've been on track to that. Right now you will see that the store count is 826 as of Q3, and the store addition is going absolutely well. There is no problem in that. In the last 9 months, I think they've added around 87 stores, I believe. And if you look at their the entire acquisition that they've done, like one of the reasons you're seeing the PAT being down is also because the losses from Cravitex, the losses from Fila that is there, it is being carried forward, right? Like for the next, I think until next quarter it will be there, that 14 crore loss, and the management has told that in previous con call also. Right now what they're doing is they're also acquiring this new American brand called Foot Locker. Now what does Foot Locker do? Foot Locker sells a lot of premium shoes such as Nike ka shoes ho gaya, Adidas ka shoes, Puma ka shoes, and Adidas ka shoes, and Uggs, the brand that is there. So these are the shoes that they sell. Now you might wonder, like Prerna, Nike to has its own outlet, so how can they sell Nike ka shoes again? So when you talk about any shoes, especially when you talk about the sneakers, whether it is Nikes and the likes of brands such as Adidas and Puma, what happens is there is a different price point that comes, right? There can be running shoes which is starting at 3,000, and the shoes can range even up to 75,000 also. The likes of Air Jordans and everything, right? It is so expensive. So when Nike doesn't give you permission to sell all the shoes, and like if you go to a Nike outlet, it is not necessary that Nike ka outlet has a right to sell every shoes that Nike produces, like from the running shoes to the premium collection. So what Nike has done is they've given the rights to Foot Locker to sell, the premium category shoes such as Air Jordans and other things. And now MBL acquiring Foot Locker, what happens? They get the rights to set up and set up and sell whatever the inventory is there of Foot Locker through MBL, and again based on that they'll have to pay a sort of royalty for them. So I believe in the next year, that is the next Q3 that we have, by then they will open around 4 to 6 stores. The only problem with Foot Locker that comes is, since it is a very premium brand and they're selling a very premium product here, they can't open stores anywhere and everywhere they want. They have to open stores primarily in T1 cities. They can't open in T2 and T3 cities. I think this is the clause with a lot of international premium brands, because if you remember, Ethos, when they opened Rimowa ka store in Geo, and it had a very good response, and people expected Rimowa will also grow at a very faster rate as their Ethos ka stores. But the management came and told like no, because Rimowa has a clause with Ethos when they were giving the rights, you can't set up Rimowa ka store everywhere. It has to be in a premium location, a very posh location. Then only they decide they just can't randomly open Rimowa everywhere. So similar situation with this one also, with Foot Locker too. And the company has like two kinds of strategy to open Foot Locker store. One, it will be a big store of 5,000 square feet, and the other one will be a small store of like around 3,000 square feet. So other than that, other than the fallen sales growth, the muted demand that is there, and the lack of operating leverage, there is not a lot of thing going on here. I mean, of course, I believe right now Metro is doing something like they want to be like an Amazon when it comes to premium footwear, because that is what you're seeing, right? If you talk about heels, they have Mochi. If you talk about women's flats, they have the Metro ka own brand, and then they have Crocs, they have Fila, which is again entering into sneaker segment. They're also getting into Foot Locker, which is another sneaker segment that they're targeting. So overall, Metro is right now in this mode of acquisition where they want to be like a one-stop shop for all your premium shoes. Like when you think about something premium shoe, you want to think about Metro. I think that is what they're targeting, and that is what they're doing. But having said that, right now the sales really need to pick up to justify the kind of valuation that Metro Brands has. Because if you look at Metro Brands, I believe, right, the PE is at 70, and it is at 50,000, I think 70,000 crore market cap. I need to check once. But having said that, when there was growth, I understand, when it was growing at a very fast rate, I understand why market rewarded that. At the similar time right now, it is very absurd also to be paying around 70p, 80p for a 6%, 7% growth in gym, right? Especially when, all the footwear companies have been talking about how muted demand has been there, and whatever we saw right now is a lot of pent up demand. And the companies like always, Nissan Nissan Joseph, Mr. Nissan Joseph has told ki like they'll do an 18% CAGR. That is what they're targeting, and roughly around 6 to 7% should be coming from same store sales growth, and the rest, the 10 to 12% that is there, it should come by adding up new stores. So that's about Metro. Again, like I told you, Metro is a very interesting prospect because ultimately it is a B2C brand, right? It has a brand, the products are good and everything, but like I told you, lack of the falling pace of growth and lack of operating leverage again makes it uninteresting. Okay, then the third category that we have is both Campus and Relaxo. Nothing much to talk here. Very common narrative between Relaxo and Campus is they have to take price cut to ensure that the volume growth is there. If you look at Relaxo has grown its sales by around, yeah, let me just get the exact numbers. I believe it is 15%. Yeah. Oh, sorry. Relaxo has grown its revenue by 5% on a year-on-year basis, and the PAT has been up by 28%. Now, of course, the PAT has been up only because raw material ka prices gir chuka hai, so they are able to take that raw material ka expansion. Because of that, margin expansion is coming from there as the raw material prices fall down, and that is why you will see also the average selling price has also fallen down. ASP is around 151 versus 163. Like I told you, volume growth is coming at the cost of value degrowth. Sorry, not value degrowth. Value degrowth is not the right word, but volume growth is coming at the cost of price cut, right? So that is the right language to put it across. So company has sold right now 4.7 crores pairs versus same time last year they have sold 4.1 crore 1 crore pairs. So other than that, nothing much. Again, Relaxo ka problem is that if they increase the price, they no longer have that pricing power, because if they increase the price, what happens, there is so much competition here in this space that ultimately they will lose out on volume growth. Agar volume growth chahiye to value mein thoda aapko price cut karna padega. So that has been the story with Relaxo. Again, like I told you, not much change. The next we have is Campus. Campus, again, at least better in terms of last quarter, because last quarter the situation was really bad for them. So I would say a little bit better in terms of from Q2 to Q3. Revenue has been flat, hardly grew by 1.4%, but the PAT has been whooping down by like literally half. Like PAT is down by 48.5%. Even in terms of volumes, if you see, last time they sold around 7 million pairs of shoes. This time they sold around 6.9 million pairs of shoes. In terms of ASP also, ASP is around 681 versus last time it was 669. Unka jo bhi issues tha, like I discussed last time with B2B platforms, O2O platforms, where they were delisted and all, that has been resolved, and now they're focusing a lot on distribution. Unka jo inventories ka problem tha, that also has been gone. A lot of destocking has happened in terms of inventory. Only problem remains here is because Campus has positioned itself as like an alternative for Nikes and Adidas and the likes of premium shoes, the likes of those sneakers. They've discounted themselves, and that's how they position themselves as a brand. So now because of that, what is happening, they're not able to increase the price. In economy segment, there has been a lot of competition. That is why you will see that the revenue right now from the economy segment that they're getting is hardly 20%. Unka jo premium category hai, which is 1500 plus, right, that is what they call as premium, 1500 plus, that is contributing 49%. Now 1000 to 1500 ka jo beech mein hai, that is contributing 30%. Now in both these categories, what they call as premium especially, although they're having a good volume growth here, right, like I mean we are seeing a significant increase in this product mix change. They're more and more they're moving towards premium, but here even premium doesn't make any sense. Like I told you, they even tomorrow if there is some problem, they can't take this 1500 ka shoes jo hai 2000 shoes, they can't take it to price like 4000 5000 and expect people to pay up. Like I told you, then people would be buying the likes of Nike and Adidas only. Why would they have to buy Campus? Then there is no, the only difference was the Campus was going to give you the Nike and Adidas ka shoe at a lower price. So here, although they're trying to increase the volumes in premium segment, because they're unable to take the price hike here, again it is playing against them. So that is another problem with Campus. The last thing is Khadims and Liberty I would put in the last segment when it comes to footwear space, because these people majorly cater in the under 500 and under 1000 INR category, and this is one segment. If you see in terms of Bata, whether it is in terms of Khadims, if you see, they've not been able to recover in this product portfolio, right? You will still see volume has degrown for a lot of companies. They're still grappling through that. The situation is no different for different for Khadim, because you will see that the revenue has been down by 4.7%. You will see the PAT has been down by 62% on a year-on-year basis. Volume भी degrowth हुआ है in a single digit. There is no price hike in this quarter. That is it. So ultimately ये सब चीज़ बुरा हो रहा है यहाँ पे. So what is the point in talking further? The only thing here is यहाँ पे company थोड़ा I think they are issuing warrants, equity shares का warrants issue कर रहा है. So they will raise money and they want to use it in expansion of stores and revamping their own stores. और उनका जो there are two how do I put this, two business for Khadims. One is unka retail ka store and the other one is distribution. Right now they're they're doing a demerger of both, and they want to list the distribution as separate and the retail as separate. Right now, here is the thing, I've gotten a lot of queries regarding this demerger, where people think like because they've seen the demerger happen of Red Tape from Mirza, and the after that the growth has been stunning, right? Like you saw the journey of Red Tape, how it was. So people think that like a similar thing is going to play out in Khadims, because of the demerger. But it is not the case, because Red Tape had growth. Jo bhi bolo, Red Tape had growth at that time, and in fact Red Tape was getting dragged down because of Mirza ka tannery business. But here you're just making one loss entity into two loss entities, right? So absolutely doesn't make any sense here. Like it doesn't mean every जो आपका QIP कर रहा है वो अच्छा है. It doesn't mean every जो demerger हो रहा है वो भी अच्छा है. So you always need to ask, like is there like any potential value unlocking that can happen here, which personally I do not see happening in Khadims, because like I told you, lack of growth and especially the volumes only are not growing here. So that is the only complaint with, I would say, with Khadims. And Liberty is also falling in the same category. There is nothing much to talk. Bata also the same thing. Their sales have been flat, and the company is focusing more and more on the FOFO, like that is in the franchise, versus the COCO stores that they're doing, and that is what they've been talking. Nothing again much happening over there also. So overall, just to wrap it up, again, out of everything, Red Tape is, according, when you look at all the con calls, when you look at all the business ideas, you will see that Red Tape is the good business here in this space. You will see it as the highest growing in terms of sales also, followed by Metro, and then of course you have the likes of Khadims and Liberty, which has really not recovered after the entire GST fiasco that happened, when the GST was increased from 5 to 12%, and the raw material inflation that happened during COVID, right? So they're still grappling from those losses, and Relaxo and Campus comes in between, right? So that's that about the footwear space. I will see you again in another video. Bye.